What you're about to watch is a real, candid call with me and my personal tax strategist, who has saved me over $100,000 in 2022. That's $100,000 that I would have paid to the IRS that I am no longer paying because of the strategies that we talk about in this video. And of course, if you are new here, my name is Michael. I am a full-time software engineer in the Bay Area and a part-time real estate investor, and I explain to people why they should be investing in real estate to grow their net worth. So before we get into the interview, if you like what you hear, you can learn more about the concepts that we talk about in this conversation in this playlist right here. Also, if you listen to this conversation and you're like, damn, I want to work with this tax strategist, the link is in the description. Just make sure to use Invest Like Mike as referral code. Okay, so now let's dive right into the conversation. We're gonna cover three main topics. Number one is going to be what is a tax strategist and how are they different than a CPA? Number two, what are the top tax benefits for high W-2 income earners? And number three, we're gonna be doing a case study of my situation in 2022. So we're gonna actually look at my tax returns for 2022 and break down why we did the things that we did. So let's jump into the conversation and I'll see you there. All right, guys. I got Ashish from the Investor Friendly CPA. This is my personal tax strategist. I thought it'd be really cool to get a video in together. Ashish, welcome to the channel. Maybe you can go ahead and introduce yourself and explain to them, to everyone who you are and what you do.
Hey guys, I'm Ashish. I'm a CPA and a financial advisor. We have a firm named Investor Friendly CPA. We strictly work with real estate investors. And when I say strictly work with, we might have a doctor or plumber, a business owner who wants to invest in real estate and save taxes and all those good stuff. Every single one of our clients have a real estate. We have a huge team and we are virtual. We do have a huge team all over the country and also in the international office. I'm an investor myself. I do have a short-term rentals. We have a multi-million-dollar portfolio of my own real estate, and we do syndications under CRE capital management. So that's a very high-level introduction.
Cool. Yeah. I mean, the reason why I ended up working with Ashish is because, I'm an investor and there are a lot of CPAs who don't really specialize in real estate. So I like the fact that you were catering to investors as well.
Yeah.
So the first question I had for you is, what is a tax strategist and how is it different than just being a CPA?
Ideally, all the CPAs should also be a tax strategist and tax planner. But I can tell you with 10 years into my career, majority of the CPA will just do the tax returns and move on without any consultation on, hey, how can you save money? How much can you save money? And lots of other discussions like those. And people lose out on so much money. And very simply, and we'll talk about this more, is if you can save $100,000 a year, that's $1 million actual cash without time value of money in 10 years. And I have clients who have worked with the CPA for 20 years, paying $100,000 in taxes. If they could have saved that money for 20 years, that's even without the growth, that's a $2 million cash that they could have pocketed and had retired already. It actually feels very bad and sad when I get older clients who have been paying a lot of taxes for a lot more years. When I get new investors like yourself and someone who is just getting started and is young, I couldn't be any happier for them because you can save so much money. Now, what does a tax strategist do? Or why is different than normal CPA is? If you just work with the CPA, if you don't pay too much taxes, you should be fine, right? If you just pay $5,000, $10,000 on taxes, can you save that? Yes, but it's not a life-changing money. But if you're paying 70, 80, 90 and up, then you should work with tax strategists. What they will do is they will look at your entire situation, what's going on, how much money you're making, what's going to happen in the next 10 years of your investments or your business, and then come up with a very detailed plan, which at least we do. Detailed plan in a written plan with a lot of numbers you can follow, not just talking because it's very complicated. It gets complicated and give you exactly, okay, if you do this, what happens? If you don't do this, what happens? And we use our proprietary modules, but there are so many other CPAs might use different softwares. Tax strategist needs to come up with the plan, and then tax filing is just an add-on. And that's what I feel like.
Right, exactly. Yeah. So it's more of a proactive approach. That's for me, that's the main difference because I've worked with 4 different CPAs before. They never gave me any advice on what I should be buying, why I should be buying it beforehand. It's more like the year goes on and it ends. And then I contact the CPA. I'm like, hey, can you file my tax return? But it's like, even if I wanted to change anything in that prior year, I can't because the year's over. So tax planning basically happens at the beginning of the tax year, not at the very end after everything's done. It's a proactive approach. Ashish helps me define what I should be buying, why I should be buying it.
and what's the most optimal way to purchase assets to help me pay less taxes. And I wanted to kind of explain for most people who don't know what working with a CPA or a tax strategist looks like. Right now, it's mostly emails, calls, and then the client portal. So Ashish is super cool at answering all of my emails if I have any questions. Also calls. So if I have maybe a question that I want to ask, or if I have like a series of questions, usually a little bit more efficient for me to schedule like a 15-minute call with Ashish, and we can knock out like 10 questions right away rather than sending 10 different emails. So that's really awesome. And then lastly, the client portal is where I upload all my documents, like my 1099, my W-2, all that kind of stuff. I'll just upload over the course of the year as I get them. But Ashish, something that you did that was really cool that no other CPA did was that you gave me a lot of spreadsheets, like Schedule E spreadsheets, Schedule C spreadsheets. Schedule E and Schedule C are basically just like Schedule E, I'll show you guys in a little bit, is basically a tracking system for how much income versus how much expenses you have in your rental property business. So if you look at Schedule E, it's basically just a comparison between income and expenses. And then at the very end, it'll spit out like a profit number. So we'll look at that in a little bit. Yeah, you provided a lot of that stuff. You even helped me set up my LLCs, my asset protection like stuff. Well, you referred me to someone who could help me out with that. So again, that's another person, business attorney. So far, that's what it's been like working with Ashish. It's super awesome. I wanted to dive into the next question real quick. So I wanted to get into the meat of this video, which is tax savings specifically for higher W-2 income earners, because like you said, if you're only paying $5,000 a year in federal income tax, then there's just not that much potential for you to save that much in taxes. So this is particularly for higher income, higher net worth individuals who are paying, like I was going to pay $110,000 in federal income tax if I did not invest at all, right? In real estate, that is. The first question I wanted to ask you is the most important question, which is, what is the most impactful tax strategy or tax saving strategy for high W-2 income earners right now? What is something that I can save like 100,000? Like, is there something like that?
There are various ways, depends on what kind of industry you're involved, what kind of business you do. I mean, if you go to captive insurance, there are so many ways to save taxes in their business. But I'm gonna focus on a very general audience who have let's say business or W-2 and wants to save, because what you're saying is very true. If you have a high earner W-2 employee, there's virtually no other ways to save taxes other than very normal 401ks, 1099s, and in IRAs. And if you're below the threshold to save taxes, everyone can do that. And hopefully most of your tax preparer, or if you do not have a CPA because you don't need one, you can Google this and you're doing this already, right? That's very normal. But as you start making more money, we'll try to diversify and invest and do a bunch of other things. That's when I tell everyone, if you're going to buy some kind of assets for your long-term retirement in a plan or wealth building strategy, why not do that in a tax efficient manner, right? That's where everything I do comes into play. And that's where I help everyone else. And this is how it works. You cannot save any taxes if you're a W-2 employee, unless you do 401ks and those very small things you can do. If you're a business owner, then you have a little more leeway, right? You can have a home office, you can hire your kids with the right kind of entity structure. You can save significant amount of taxes, but it's not going to wipe out your taxes. And I'll tell you how to wipe out, but it's not going to wipe out. And this is what I mean. Think about a business owner. Let's say, for example, me, right? I have my firm and it makes it $2 million. I can only write off so much. If I make $2 million and spend everything on vehicle, auto, retreat and conference, why did I work so hard to make millions of dollars and spend all of it in business expense and not pay any taxes? It doesn't make sense, right? And that's how every CPA is trying to explain to other clients, expense this and you can save taxes. I would rather keep the money and not pay the tax. And that's where real estate comes in. Very simply, if you have a slight understanding of depreciation, or if you do not know this, I'll just give a very 1 minute talk about this, right? Depreciation is when you buy an asset, you can write off the asset. Normally, other kind of assets like printers or laptop, it actually depreciates, you write it off, you move on. But real estate, it actually appreciates when you go sell it, but you can write it off when you buy the property. So you're writing off the property that actually appreciates. That's the one thing I want everyone to take away if you don't take it nothing. Why is real estate so important? And why do all these millionaires, as soon as people start making $200,000, $300,000, $400,000 in W-2, start investing in real estate? I mean, you will buy some kind of stocks or bonds or assets, but when you buy real estate to diversify your portfolio, you're not only buying real estate, you're buying a long-term wealth that appreciates, but you're also wiping out your taxes. And and you can literally wipe out your taxes if you want. I think what you're asking is, hey, what is one way they can save taxes is make money, first of all, pay a lot of taxes, and then on the back end, talk to your advisor how to invest in right kind of assets. I'm not saying just buy real estate. That's when you buy, though, make sure you're meeting all the rules, rep status, material participation, all the loopholes to save taxes.
Right. Yeah. So one of my favorite sayings in real estate investing is that real estate investing is one of the best assets to invest in because it's one of the only assets that depreciates and that gives you humongous tax benefits, but at the same time, it appreciates. And the great part about that appreciation is if you do it right, you don't have to pay taxes on that appreciation either. So it's like a humongously tax efficient investment. So you said there's a potential to wipe out. We're talking about federal income tax because a lot of the concepts that we use are federal tax law. So it applies to every state, right? I live in California. There's federal income tax and state income tax, but we're mostly talking about federal income tax here. So the first thing you mentioned is real estate professional status and material participation. So you said, how would one basically wipe out their taxes using real estate?
The rules around rep status, real estate professional status, or material participations can get very complicated, especially, depending on what your household is like. I'm going to go very high level on those. But when you buy real estate, basically just to continue what we were talking about before is other businesses, you have to go spend the money to get the deduction. Real estate, you put a down payment, banks gives you, let's say 80%, and you use banks' money to write off. You're not even writing off your own money. You're using banks 80% to write off your income. How do you write off is real estate. You can depreciate the asset, right? And there's so many rules about depreciation, but when you write off real estate you buy through cost segregation or, improvements or repairs or losses you can create with real estate, if you plan real estate involvement, your household involvement in real estate correctly and qualify for the rules, then the phantom loss, fake loss from depreciation from your real estate can directly offset your W2 income, right? That's very high level, or a business income or capital gain, any kind of income. If you can release the loss with real estate, very important. I know there's some points that you guys not going to get it because when I say release, sometimes it will be limited because you're not rep status and all those things. But if you work with a real estate CPA or investor-friendly CPA, we can help you navigate these complicated rules. The goal is pretty simple. You have in 2023, you can offset up to around $550,000 of W2 income. That's a huge amount. If you have $550,000 as a married couple of W2 income, you can completely wipe that out with right kind of real estate purchase in this bucket. But you have to meet all the rules and everything. And we're talking about saving. If you're making $500,000 married couple in highly taxable state, we're talking about $190,000 in taxes. You can save that. Ideally, you can save that completely if you invest in real estate correctly, right? And that's where the depreciation and everything comes into play.
Right. Yeah. So the main point here is depreciation is like the core centerpiece of like how we save money in taxes in real estate. Now, there's other deductions that are more minor, I guess, but the big fish is depreciation, and it's a big fish by a lot. It's not,
And one thing, Michael, and I think I've said this to you as well. As an investor, you have to be very careful how you do this, right? You do not want to just be very aggressive in deduction. I'm very aggressive legally following all the rules and wiping out taxes, but you also have to say like investor. You don't want to go and write off your $50 meals or be aggressive with deductions, travel, all those things. If you try to write off everything in your real estate investment, you will not qualify for the loans. The bank will shut you down. So what you need to do is make sure you're not being too aggressive, make sure the property is making money, and then on the back end, taking depreciation to wipe out the income. Because depreciation wiping out the income does not impact your lending capabilities in a DTI, debt to income ratio. That's something everyone misses. And CPA, I get so many clients saying, hey, can you amend my return because I'm not qualified for the loans because my CPA never told me. Because their CPAs are not investors. They don't do real estate. I've been through the pain of disqualifying for the loans for the exact same reason. So I know exactly how your tax return needs to look so you can qualify for the loans while not paying any taxes. That's very important.
Yeah, that's a question that I get all the time is like, damn, like if I pay no taxes, if I reduce my taxable income by so much and I show like zero taxable income and I pay zero taxes, like how am I going to get a loan, right? And so like you just said, the banks will add back that depreciation deduction, which is going to be a big part of reducing that taxable income. So let's move on to the next section. I wanted to do a case study of how my taxes looked in 2022. And I'm going to show actual screenshots of a tax return draft that I have. It's not the final version, but it's a good enough idea to show you guys exactly why depreciation is such a big factor in this whole strategy. So I'm going to share my screen and I'm going to share my Schedule E. It's a comparison between the income versus the expenses that my properties produce. So you can see here that there is two properties, property A and property B. And then on the top line, we have the rent collected. One of them I had for the entire calendar year. The other one I bought towards the back half of the year. That's why the income is a little different. So 17,000 and 46,000. You have a bunch of expenses here, like you have advertising, auto and travel, cleaning, maintenance, commissions, insurance, legal professional fees, management fees, mortgage interest payments, which is a pretty significant deduction here for at least for one property. And then you have repairs, supplies, taxes, utilities. Notice all of these deductions are like less than like $10,000. They're not significant, right? Except for like maybe mortgage interest. But when we get down to line 18, you see that we have a deduction that is $213,000 for one property and $180,000 for property number B. This is why we talk about depreciation so much, right? This is the big fish that we're talking about. So how does it even make sense that a property can produce only $17,000 or $46,000 worth of income, but allow me to take a deduction like that large, like $213,000? This is not normal depreciation. We're getting into the territory of what's called bonus depreciation. So could you explain bonus depreciation? How are we able to get this $200,000 deduction?
I want people to understand that you can, in line 22, or if you look at net income, he has a net income of negative $389,000 in total. That doesn't mean that he lost $300,000. This is exactly what we were talking about before. If you remove that depreciation, which is a phantom loss, it's just that's the bank's money you took, bought a property and you're writing it off. If you take that off, he probably makes money from the rental properties. And that's the goal, right? We want a good cash flowing properties and then do this so we can also save $100,000 in taxes. And that's exactly what I think Michael saved in $100,000 in taxes. Yeah. To explain this, depreciation and bonus depreciation is, again, it's a tax rule, it's an accounting rule. Everyone probably have touched upon this in school, but it gets very complicated. The concept is when you buy an asset, you can write off slowly over for real estate, residential, 27 and a half years. If Michael bought $1 million property, he could write off around $23,000 if he does a normal depreciation. Where bonus depreciation comes into play is there are ways where you can write off things faster. That's what the bonus depreciation is. That's where you see that $213,000. If you have an asset and it qualifies for a few rules, then you can directly write off then the first year. You don't have to wait 27 and a half years. And furniture, appliances, land improvements, equipments, right? Those kind of things which are in your real estate can be written off right away. It used to be 100% written off, write-off in 2022. It's going to go down to 80, 60 and down until 2026. So 2023 and 2024 is going to be extremely good year to do this again and again to save hundreds of thousands of dollars in taxes. And after that, hopefully the law will be, I have a feeling that, after the elections and everything, the bonus depreciation is going to bounce back up at least at 50%. And, people do this every single year. But again, it is a good year to do this. That's what bonus depreciation is. You get to write off the assets as a bonus the first year rather than a normal rule of writing it over 27 and a half years.
Right. There's one other concept called cost segregation study. And in layman terms, I kind of was able to kind of simplify the definition of a cost segregation. And basically what a cost segregation study is, Ashish was mentioning that there are certain assets within your home that you can depreciate in 1 year, right? Versus like over this 27.5 years. So a cost segregation study essentially identifies the components within your home that have a useful life of 15 or 20 years or less. And essentially what it does, like, for example, your refrigerator is going to have a useful life of like, let's say 10 years, but more foundational things like, again, the foundation or the beams inside the home, like the wooden beams that hold it up, those are going to have a useful life like of a lot longer than 20 years. So essentially the cost segregation is going to identify all of those components with a useful life of 20 years or less, and then give those components like a monetary value. And that is what a cost segregation study does. Bonus depreciation allows you to take the value for all of the components within your home that have a useful life of 20 years or less and take them as a deduction in year one. So my cost segregation study report, if you look at it, it would basically tell you that for my property A, that basically I have about $213,000 worth of assets in my home that have a useful life of 20 years or less. And so when I combine the value of all those components, I can take that as a deduction in year one. That is bonus depreciation, right? You can see here that when we compare the income and then the deductions in this property, the biggest deduction being, again, bonus depreciation here, between the two properties, I'm actually losing $389,000 in 2022. So this is what we refer to as a passive loss. And what are we able to do with negative $389,000? Like, what is this? Why are we trying to make our business essentially lose $389,000 per year? And one thing that you have to note about Ashish has been emphasizing this phantom loss. The idea with the phantom loss is that I'm not actually spending money out of my pocket. Like, for most of these expenses from like lines 5 through like 17, these are all dollars that I had to spend in order to get that deduction. But the difference between these deductions and then the depreciation deduction on line 18 is that line 18, I didn't actually spend $200,000 or $183,000 to get that deduction. So that's the power, because I'm essentially saving taxes without even paying a single dollar to get access to that $200 or $183,000 deduction. And I have another screenshot here that I'll pull up in a sec. Let's look at this one real quick. So this right here is my wife's income. She's a real estate agent. So she brought in, let's say, $116,000 in 2022. We're actually able to completely wipe out her income using this passive loss and still be left with negative $272,000 even after wiping out her income. So now this means that we're not paying any taxes on her income.
The only tax you're paying is self-employment tax. That's what that Schedule C needs to go away next year. And I know you didn't have...
Right.
This is a very good example, right? Even if you had $300,000, almost $400,000 of any other income, you would pay zero taxes. And that's almost, $80,000, $90,000 tax savings.
And so let me share this next one. So we wiped out her income. We now have $272,000 of passive losses left over still, right? We are still able to use those. So the next one I wanted to show is, this one shows my income and getting wiped out with the remaining passive losses. So let's say I brought in, again, $300,000 in 2022. I have some deductions here. I have some capital gains from selling stocks. And essentially, again, we're applying remainder balance of my passive losses. So from that $300,000, I'm deducting $272,000. And so you can see here at the very bottom, the number that we care about, after we apply the standard deduction, my taxable income at the very bottom here is $22,000. And this is the number that I report to the IRS as saying, this is how much money I made this year. That's the bottom line number. And I calculated yesterday, if I report $22,000 of taxable income to the IRS, my tax bill for federal income tax is like $2,200. That's $2,000 essentially. And that's a huge tax saving, because if I report $400,000, my tax bill would literally be $110,000. So I'm reducing my tax bill from $110,000 down to just $2,200. So that's a tax savings of well over $100,000. I guess the question I had for you is, like, how am I able to take this deduction directly against my income?
It's a loss. We talk about how we harnessed it. Now, loss is a loss. If you have income, you can use losses to offset your income and pay zero taxes. But not everyone can do that, like you said before, right? There are a lot of limitations on the passive activity loss rules. I'll tell you how, very simply, I'll tell everyone, how can you release that loss, such as Michael has done here. If you're investing in real estate, there are 3 ways to do that. The first way is, if you make less than $150,000, then you can offset up to $25,000 of taxable income. And for someone who's making $150,000 and less, offsetting $25,000 of highest tax bracket is a pretty good tax savings. Okay, so that's the first way. You don't have to qualify as reps, or you don't have to qualify as all this material participation. All you have to do is manage your property as actively, and you're fine. That's the first way. Second way is what Michael did.
So for that first method, you're saying that this number could be at max negative 25,000. You only qualify for that if your income or AGI is less than 150.
Yeah. If your income is at $100,000, like AG, it's called Maggie, but adjusted gross income is at $100,000, then you get entire $25,000. There's a phase out. For every $2, it's $1 phase out. Meaning, if you make $125, then you only get $12,500. But what you said is correct. If you make anything less than $150, you get some kind of deduction there. The maximum being $25,000. That's the first way. The second way is what you did. See, there's no limitation. You took entire almost $400,000 and wiped out your wife's income and W2 income and everything, right? How did it happen? You invested in real estate. You did everything, cost segregations. You harnessed all the loss. Now, you also had to qualify as, real estate professional status, rep status. You made all the rules, you tracked your hours, there are certain thresholds you got to meet. You met those, and then that's the second way. You met the requirement. Now, very high level, the requirements are to be a real estate professional, you have to work 750 hours in real estate in materially participating activity. And also, you also have to spend as much in real estate as in any other things you do. For Michael, he has made the rules. I'm not going to go in detail how he made the rules, but he has made the rules so that he got this. But not everyone can meet this rule, right? That's why I was saying there's another way, and we can talk about that. But first way was making less than $100,000, between 100 to 150. Less than $150,000, you get some deduction. Second way is to qualify as reps. What we're seeing here, if you qualify as reps, if your spouse is involved in real estate, or you are involved in real estate, or you work part-time and you also get involved in real estate, you can qualify as reps if you follow the rules. But if you have a full-time job, if you and your spouse both have full-time W-2 job, it's very, very, very hard to qualify as reps. I'm not saying you cannot qualify. If you work double shift, you'll qualify, but most of the people will not qualify. That's why this is fairly new, and it's going to last for, I think, next 2 or 3 years, is what we call short-term rental loophole, right? And here's a reason why it's new and everyone is doing it and everyone is saying the same thing. Even though you are a doctor, engineer, have a full-time job, if you do a short-term rental loophole, you can achieve the exact same benefit what you're saying in Michael's tax return here. If you invest in short-term rental, short-term rentals is basically opposite of long-term rental. Long-term rental, you buy a property, you have long-term tenant there, 1-year lease, 5-year lease. Short-term rental is Airbnb, Vrbo, vacation rental, right? Less than 7-day average. Your tenant, the guest, has to stay in your property less than 7 days on average. If you can buy that kind of property, exact same result without having to qualify for those complicated rep status rule. And short-term rental, again, there's material participation, a lot of rules that comes into play, but those are 3 ways. 150 or less, qualify as reps, or try to invest in short-term rental, especially next 2 or 3 years because of the bonus depreciation being still high and short-term rental market not being saturated. Because I can guarantee you, it was a lot better 2 or 3 years ago. Now it's being saturated more and more and more. And there's going to be a point where not every house can be short-term rental, right? There's going to be some point where this loophole is going to not even make sense because bonus depreciation is going to go down and every house in the neighborhood is an Airbnb. So next 2 years is still a good year to implement the short-term rental loophole.
Right. There's a slight difference between the short-term rental loophole and real estate professional status, but essentially both of them allow you to take losses from your rental property and apply them directly against your W-2, which you would normally not be able to do without real estate professional status or without the short-term rental loophole.
Just so people need to understand, it's just not W-2 income. If you have a capital gain or if you sell a stock or crypto, you have $1 billion in crypto sell, you can offset that too. $500,000 of capital gain and W-2 income can be offset. If you have a business income, if you have a business and you have $1 billion business income, you can offset the entire thing. Just like what all the lawmakers do, right? The presidents, Biden, Trump, doesn't matter which party they are, they pay 0 taxes because of the exact same reason what you're talking about. Every lawmaker is, I'm not going to make that claim, but they make good money and they will invest in real estate for the exact same reason what we're talking about. And the rules are also favorable because they make the law.
Right. That's exactly what I wanted to say. So there was one downside to this approach. Okay, so let's move into that next part, which is we've only talked about the pros. What are the cons to this approach? Well, the main one I wanted to kind of discuss was depreciation recapture. And so a lot of people ask me about depreciation recapture and they use it as an excuse not to use this strategy. So what would you say to them? Like, what is depreciation capture? What would you say to that? And then I think we'll close out after that because we've gone over a little. Maybe you can explain that and then we can close out. And then for those of you guys who are watching, I'll go ahead and leave the link to Ashish's firm in the description, so you guys can go check that out. Let's talk about depreciation recapture for like 2-3 minutes.
Absolutely. And by the way, if you ever reach out to me because of this video, make sure you mention Mike there because I want him to understand. I appreciate you coming, having all these people reach out to me. Make sure you mention Mike and invest with Mike there. Depreciation recapture is an issue, but it can be managed. And I've seen people mess this up. If you're going to buy a property and hold on to this property until you die and give it to your kids, there's no recapture. Okay, you can write off the property entirely, $5-10 million big commercial property, and there's no recapture when you die. So you wrote off. Your children will they take that asset and all those things, right? Tax-free. And they can also do a bunch of other things, but let's ignore that. Recapture is only a problem if you do one thing. You do cost segregation on the property today, and then next year, right away next year, very fast to sell the property. Then you have to recapture all the benefit you got from the cost segregation and bonus depreciation, right? Now, is that a bad thing? Yes, but I have clients who needed $100,000 cash inflow to make a deal work. They did this and sold this and paid the taxes almost 2 years later. This can defer your taxes. So sometimes even, doing this even with recapture issue, for cash flow management perspective, people have done it, but I don't suggest it unless in a desperate situation. You can do cost segregation on the property you're going to sell it just to have refund money, $100,000, buy a very good asset, and then after 2 years, when you file the next year's taxes, pay the taxes on a recapture. It's a free loan. But how to manage recapture? This might be a little complicated, but I just want to tell you this very, very briefly. So if you work with someone else, they understand this. You do cost segregation on a property, let's say $1 million property, and you segregate $200,000, just as what Mike did. And the $200,000 is due to bonus depreciation. When you take bonus, it's expense, right? That those assets, if Michael sells this asset, let's say next 5 years, you sell this property because you got $2 million offer and you sell this property. Do you have to recapture the entire $200,000? No. Even you sell it, you don't have to recapture it because you waited a few years. And here's the reason. You have to only recapture the gain you make on the selling the asset. When I say gain, what is gain? Gain is basically sales price less your basis. On the asset you took bonus depreciation, you have zero basis. So if you sell the property right away and the value has not depreciated, you have to recapture the entire thing. However, if you wait 5 years, when you sell the property, the cost segregation firm allocated $200,000 to your appliances. Let's say everything's appliance, let's say. In 5 years, we can allocate $10,000. Your recapture is only $10,000, right? Because all the appliances, they're salvaged. The new owner is going to buy new appliances anyway. Who's going to keep, 7 years old appliance, let's say when they buy the property. They're going to throw it anyway. So its value is zero. So we're going to allocate value, let's say $10,000, very salvage value. 5 years ago, you got $200,000 deduction for that $10,000 you're going to recapture in 5 years. That's nothing. Recapture and $10,000, you're probably going to pay $3,000 in tax. And if you have right strategy in recapture year, you can also avoid that recapture anyway with the same strategies or other strategies. Recapture is scary if you don't plan for it. If you plan for it, it can be fine.
Exactly. There's nothing to be afraid of. And personally, I don't ever plan on paying depreciation recapture because, as long as you never sell, you're never going to have to pay depreciation recapture. You can always 1031 exchange and just never sell. Or Ashish was mentioning that you can just sell after some time.
For the 1031st exchange, if you do cost segregation, you can avoid one kind of recapture in real estate. The other kind on a personal property, you're going to have to recognize again. But again, if you do 1031st exchange in 5 years, again, same issue. There's no recapture. Or recapture is going to be very minimal. You can manage it. That's what I'm saying. You can manage recapture if you work on it.
Or, the same year that you have a huge depreciation recapture, right? Let's say I do want to sell in 3 years and I have like $100,000 of depreciation recapture. Could I go buy another property, do the whole bonus depreciation thing on that, again, create a $300,000 loss and then use that to offset any depreciation recapture?
Exactly.
That's another great strategy.
That's what I'm saying. If you're gonna do this more and more, you get involved in real estate more and more. It's a matter of time when you're gonna be investing in $2 or $3 million commercial property, and those property, if you start investing in those kind of property, you pay zero taxes for the rest of your life. So recapture can be managed if you plan for it.
Yeah, well, I hope to get there like you, Ashish. I'm not there quite yet.
No time. In no time.
Cool, Ashish. Really thankful for you coming on, giving us a whole talk on tax strategy. It's super awesome stuff I've been obsessed with lately. Why don't we just reiterate where we can find you? Again, I'll leave a link to the description for Ashish's firm, the Investor Friendly CPA. And again, please, if you find this video and you thought it was useful, go schedule a free consultation with him and just make sure that you mention Invest Like Mike referred you when you fill out the new client form.
You can schedule a free consultation call with me. But before you do that, you got to do one more step. Go to my website. I think every page has client intake form. You fill that out. When you fill that out, it says who referred you. Just make sure you put Invest with Mike, and then you'll see how to schedule a call with me after you fill out that form out. And again, don't hesitate to reach out. There's a contact form, a lot of other forms. If you have questions, reach out to me. What people don't understand is I'm not like other CPA. I give so much time to other people, and I'm so generous with my time. If you email me your questions, I'll answer them as an investor friend. Okay, do not hesitate to reach out if you're not getting the best, or if you think your taxes are not done correctly. ask me some questions. I'm more than happy to look into it. Okay.
Cool, Ashish. Really appreciate it. Was there any last things that you want to mention that we might have missed?
I'll tell you what is the most important thing, which a lot of people are missing for 2022 tax year, is that we talk about all of these cost segregations and everything, a short-term rental, rep status, but you don't get benefit from doing cost segregation on your long-term rental if you're not rep status, right? And I have so many clients with long-term rentals, no rep status, have a full-time job. So this short-term rental loophole in the next 2 years, if you're going to buy a short-term rental in the next 2 years, let's say buy 1 or 2 or 3 short-term rentals, 2022, if you have not filed a return, which is early enough, hopefully if you have extended, you have not filed, make sure you talk to your CPA about doing cost segregation, even your long-term rental, even though it's not going to benefit you this year. I know it's complicated. Talk to your CPA. They will help you out. If they don't know what they're saying, reach out to other real estate CPA or email me. I'll help you out. That's the most important thing I want to leave with, because you're going to cry next year when you have to redo this and file some forms. It will cost you $5,000 to fix this.
Yeah, that did cost me once because I did not know that. Yeah, thanks so much for joining, Ashish. Really appreciate your time. And again, if you guys want to reach out to my personal tax strategist, Ashish, again, go to the link in the description, go check out his resources. Once you sign up with him, it's really easy to onboard with him. He really educates you on what you need to be doing and how to work with him. That really impressed me as well, as your onboarding process was super easy as compared to a lot of other CPAs. So anyways, again, thanks for joining, Ashish. And yeah, we'll talk soon.
Perfect. Hey, nice talking to you, man. Take care.
All right. Take care. Bye.